Guys, what's going on? Amir Garami Ray Cruz with MCF Mortgage, coming to you right before the holiday season. We've been on sabbatical for the past, I want to say 3 years. That's right, Ray? 3 years or so?
I think 3 years it is. Yeah.
Yeah, so we've been on sabbatical for 3 years. What we've been doing in the past 3 years.
I'd say we've been busy for the past 3 years.
We've been busy. We've been busy for the past 3 years, growing MCF Mortgage, and that is the reason why we have not been able to put up any videos or discuss some of the nuanced deals that we close that others can't. So just a bit of recap, what has happened in the past 3 years. MCF Mortgage is a retail platform. We had a lot of demand from realtors to provide this to their mortgage lenders of choice. So we grew MCF Wholesale, which is available to other mortgage brokers who want to use our products. So MCF Wholesale was spun out. Right now we have over 8,000 or so loan officers that use our products. We also expanded into more states. We're now lending in about 40 states. MCF also ventured into the commercial real estate space because a lot of the investors we work with buy commercial properties. So MCF CRE was also born over the past 3 years, and that provides commercial financing similar to what we do right now. No income, no documentation, light documentation type of loans. And MCF Trust is a family office for investment purposes that's also been born to support everything that has gone on over the past 3 years. So we came back because we kept getting harassed. People wanted to hear about these deals, how we structure our deals and what we do. So we'll try to be more consistent moving forward now that things are somewhat in order. Growth is hard, it's exciting, but it's also very hard. So today we're going to go over a deal that Ray closed, where, DC?
Yeah, in Washington, D.C. This was actually a client that had done a transaction with us in the past and now was actually just looking to pull some cash out and also reduce their rate a little bit, because the initial transaction on the purchase, they had a higher rate at the time just because of the documentation and how we had to do the approval. Now there were more income sources. So although actually start at the beginning when I initially got the call was that the client had reached out to Rocket Mortgage, and Rocket Mortgage had offered them a rate, I don't know, something in the high fives, which was a great rate, in today's market. But at the end of the day, after having the borrower pay for 2 appraisals because the property, it was a super jumbo loan, it was a $3 million plus loan, and so they had to pay for multiple appraisals. And after about dealing with them for about 3 months, I think the client just got fed up with them and realized it was going nowhere fast and reached out to me. And basically, came clean and said, "Hey, Ray, apologize for not getting in touch with you first, but I've reached out to Rocket Mortgage. So they've been, dragging me through the mud to try to get this thing done, and obviously it's not going anywhere. So what can you do?" We were able to help them out. We weren't able to get a rate in the upper fives, but it was in the mid sixes, which was about a point lower than what he had before. Plus, he was able to get, the additional $300,000 in cash that he was looking to walk away with after closing the transaction. So we were able to, as usual, use multiple sources of income with this borrower who was self-employed, actually in the real estate industry himself. And we were just able to use, some of his commissioned income. We were able to use some income from investment properties. The borrower also basically was an investor himself, where he fixed and flipped properties. So we're able to use that type of income to qualify. Borrower also had some dividend interest income. we were able to use that to qualify. In essence, we were able to use just essentially every source of income that the borrower had to qualify. Not once did we ever ask him for tax returns, which was, of course, exactly what Rocket Mortgage was trying to qualify him with, right? So I did tell him, being in the industry, of course, I thought he would know better, that Rocket Mortgage would have never been able to do this loan for him. But of course, being in the industry, you know, he always thinks that there's a way, or a common sense way, for a lot of these other mortgage companies or banks to do these loans, but I mean, they just don't do it, right? So we were able to close. It ended up taking about 3 weeks from start to finish. He ended up being obviously super happy with us, and we're actually currently working on another transaction for him for an investment property, where he tells me this time he did not go to Rocket Mortgage at all. So,
You didn't stop.
got to take him for his word.
Let me ask you, so was this just some details, principal residence or investment home?
This was a primary residence.
Okay, anything, any nuance, like issues with it? Was it a 1 unit, 2 unit? What was it?
Right. So this was actually a multi-unit property,
Okay.
as a primary residence, where the borrower did occupy one of the units, and then, you know, basically did short-term and long-term. Actually, one of the units was for long-term leasing rental, and the other unit he used as a short-term rental, like on Airbnb and VRBO.
So you used, just so for people that are watching, income-wise, you said no tax returns were used.
Correct.
So you used, what did you exactly use to document income? So, because many people may not know what that means, to use a tax return or not. So what is it? What does it mean?
Right. So not using tax returns basically means, look, for his VRBO and the short rental income, we can use the transcripts right from Airbnb, right, to show income. For the real estate income, we could use this actual transaction history from the organization, the real estate agency that he worked with, the brokerage, right? We could use from the actual flips that the borrower did, the fix and flips. We would actually use the HUDs, the settlement statements, the ALTAs, right, to show that he was receiving income. And then we tie it all together with multiple bank statements. So, you know, the client had multiple businesses. You know, I believe he had like 5 different businesses with 5 different bank accounts, right? Wow. And a different bank account for each business. So then we just basically tied it all together with the business bank accounts for each company, where we can see the fix and flip, right? We can see that income from those ALTAs coming into that particular bank account. So he kept, you know, lucky for me and lucky for our processing team, he kept really good notes, kept everything clean. He didn't really commingle businesses like some borrowers do, right? And he also didn't use his businesses as personal piggy bank, which some borrowers do. Right? He had his own personal bank account, which he used for his personal business. So in that sense, it made it actually easier for us to qualify him and for us to go through all of the different income sources that he was using.
So when you refer, and I'm getting kind of into the weeds of it, on a tax return, someone who's, I presume, you know, he's a high income earner, and he sounds self-employed. So tax returns have write-offs, right? So although he might have earned, I don't know, $500,000 to Uncle Sam, he may have only shown $100,000 after all the write-offs, right?
Correct. And I'll actually give you, you know, closer numbers. So his gross income was 3 million plus, right? So the top line on the 1040, right? Good earner. His taxable income, right, was $15,000. 15,000 was the taxable income.
You need some food stamps,
so lots of write-offs, right? Yeah. Lots of write-offs, write-downs, especially with property, right? You're in the business, so you can write down a lot of property, right? So so you know what I didn't get from the get-go was the initial loan officer that he was working with at Rocket Mortgage, being that they only do or go off of tax returns. When that loan officer saw that tax return with a taxable income at $15,000, regardless of, you can add back in some items like depreciation and so forth, nowhere was it going to be close, right, to qualify for a $3 million plus mortgage.
How much income did you need to qualify this guy?
That's a good question. I don't recall.
I'm sure more than 15,000, right?
I mean, more than, listen, he showed 15,000 a year. We needed much more than that per month. I mean, it was in excess of about, I believe it was about 75,000 a month.
Got it. Okay. So now you mentioned that you married different types of income from his Airbnb transaction log or his VRBO transaction log, the commissions he receives on his real estate transactions, profits he makes off flips. There were so many different types of income, but you married all these together. Now, we're not the only portfolio lender out there. Can every portfolio lender do this, or is it limited? Some don't, some do. Why is ours special?
That's a great question. So can every portfolio lender do this? You and I don't have no idea what other folks are doing or not doing, right? What we do know is what we do, and we do well, right? So, in that sense, our team, when we're taking in an application up front, right, and we're looking at all these different types of income sources, we're able to assess whether we can actually help this client out or not. In this sense, because of he did have all of these different income sources, right, we're able to put it together. And by the way, at a great rate. A lot of times, people shy away from portfolio financing because they think, rates are going to be in the teens, and they're not. In this case, the rate was in, I believe, in the mid sixes, low to mid sixes, to slightly higher than what Rocket Mortgage was giving him, right? Yeah. On top of that, right, it's the service that you provide as a lender, right? Just taking the client from start to finish. I think our team here does a wonderful job providing white glove treatment throughout the entire transaction, right? Yeah. I think that's what really sets us apart.
So on you brought up rate. Everyone's rate sensitive, right? That's not an issue. But obviously this gentleman was in the real estate business. Did you guys ever have a discussion? Because this is a discussion I get a lot is, I don't want to pay income taxes more than I need to. I need to take these write-offs. Is it more beneficial for me to pay income taxes, pay a higher rate? What are your thoughts on that? What kind of math do you guys go through when you're doing this kind of stuff?
Another solid question. So these are questions I actually go through with the client, right? They need to do that math, right? Because we don't know what tax bracket they're in. We don't know how much they're paying or how little they're paying, right? So at the end of the day, they need to figure out, okay, is me paying a slightly higher rate, right? Does that offset me paying Uncle Sam, 60? Let's say, for example, this particular client, right? Let's say if they were to disclose maybe, enough income to qualify for a mortgage like this through Rocket, right? They would probably have to disclose probably, I would imagine, about $750,000 a year, right?
Right.
That's a lot of income. That's a lot of taxes that you're going to have to pay, right? So there's the cost analysis, right? How long is it going to take you to recoup that cost, right?
Right.
So again, paying a little bit extra on rate, maybe a half a point or 7/8 of a point on rate, where it becomes tax deductible. I would always say advise, talk to your tax advisor, right?
Right.
But doing that math, I would say 11 out of 10 times, it's going to make more sense to take the higher rate than to pay Uncle Sam.
Yeah, fair enough. So yeah, guys, there's a value to the higher rate because any borrower, when you're not paying, your state income tax at whatever that rate is and the federal income tax, you're saving quite an amount of money, and the break even is probably not even there. You might have to keep a loan for 15, 20 years before you meet a break even point. So I know this has been running long. We'll try to bring one of this to you guys every week. We'll rotate between novel deals that we're doing. This one was for a primary with, again, alternate income documentation, no tax returns, no W-2s, nothing like that. And then we'll also bring the Mortgage Intelligently University, where we go through products and discuss different products and options to help you guys better gauge what you can do whether it's for a primary residence or for an investment property.
And when when this particular borrower actually finishes the transaction we're currently working on, which is for an investment property, that's another great one we can chat about on another one of these.
All right, sounds good. Thanks so much. All right, guys, reach out to us if you have any questions or concerns.